Picture this. You've got record-breaking sales literally walking right through your front door. Business is booming. But at the exact same time, you have to call up your shareholders and tell them their quarterly cash payout, yeah, it's been slashed to absolutely zero. Nada. That is the exact bizarre situation Northern Technologies International Corporation, or NTIC, finds themselves in right now. Welcome to this explainer on the Edgar brief. Today, we are cracking open the Q3 2026 10Q filing from NTIC, filed on May 31st, 2026, and we're going to translate all that jargon right into plain English. Quick note before we jump in, though, we are independent, not SEC affiliated, and definitely not your financial advisors. We use AI to summarize these docs, so errors can absolutely happen. Always verify on sec.gov before you make any money decisions. Okay, let's dive into this. $0.00. That is the defining paradox of Antique's current quarter. Because despite the company generating over 12% more top-line revenue than they did at this exact time last year, they were forced into a corner and had to completely suspend their cash dividend. Record sales, zero dividend. It's kind of wild, right? Well, to understand exactly why that happened, we really need to understand how the money actually flows through this business. So, Section 1, the business model. Let's talk about the two-sided vending machine. You can basically think of NTC like a massive two-sided vending machine operating in over 65 countries. On one side of this machine, you have ZeroCest. Think of these as magic umbrellas for heavy industry. They sell these proprietary rust and corrosion prevention products to automotive, mining, and oil and gas companies to protect their massive metal assets. Okay, now on the other side of the machine, you have NatureTech. This side sells disappearing, fully compostable wrappers and bioplastics meant to replace traditional petroleum-based plastics. So how do they actually make their money? Well, two ways. Direct sales to customers, of course, but also by collecting a cut of the action. Think fees and equity income from a massive network of joint ventures all around the world. So basically, NTC is a two-sided vending machine that makes money by selling specialty materials and collecting global partnership fees. All right, let's move to Section 2, the scorecard, or as I like to call this one, the leaky bucket quarter. So the good news up front is that top-line revenue is definitely up. Last year, Q3 brought in about $21.5 million. This year, that jumped up to just over $24.2 million. That's a solid increase of over 12%. By all counts, more dollars are walking in the door. Demand for ZeroCest is up, demand for NatureTech is up. On the surface, it looks like a total win. But I call this filings vibe the leaky bucket quarter for a reason, and you'll see exactly why in just a second. See, here is where the bucket really starts to leak. We need to talk about gross margin. Gross margin is simply how much money sticks to the ribs before you have to pay for things like payroll, rent, and ads. For EnterTech, higher raw material costs and some increased discounts on their selling prices cause their gross margin to shrink this quarter. So they are selling more stuff, but actually, scratch that. They are selling a lot more stuff, but making slightly less on every single item they sell. And look at how this just cascades right down the income statement. Sales go up from $21.5 million to $24.2 million. Awesome. But because that margin shrank, the actual gross profit dropped slightly, going from $8.2 million down to $8.1 million. And by the time they paid all their operating expenses, the actual bottom line, the net income attributable to NTIC, fell from a positive $121,000 last year straight into a negative $263,000 loss this year. This right here, this is the literal definition of profitless prosperity. Section 3, the moat check. How well are they defending the castle? Okay, before we sound the alarms and panic, we have to ask, are they at risk of being completely crushed by a competitor tomorrow? Let's check their defenses. Truth is, they actually have some incredibly durable advantages. First off, that's ZeroCest brand. It has over 50 years of history in heavy industry. You just don't swap out your rust prevention supplier on a multi-million-dollar oil rig overnight. It's too risky. Second, they have proprietary patented technology powering those NatureTech bioplastics. But honestly, their biggest moat is that massive network of joint ventures spanning over 65 countries. Think of these joint ventures like global toll booths. NTIC provides the tech and the brand name, and in return, they just sit back and collect service fees and equity income from around the world without having to go build massive expensive factories themselves. Section 4. It's time for reading between the lines on oil, gas, and taxes. So the moat is solid, but if we dive into the management's discussion and analysis section, the MD&A, we can start to see if management's excitement actually matches these leaky numbers. And what's super interesting here is how management frames the rising costs that pushed them into that negative profit territory. They aren't hiding from it at all. They're owning it. They're calling these higher expenses strategic investments to capture the oil and gas sector. They're out there hiring specialized personnel, spending heavily on travel, all to win these massive industrial contracts. They're basically treating this short-term profit hit as a calculated attack plan to buy future growth. Now, another key nugget buried deep in that MD&A is a note about a drop in their service fee revenue. At first glance, lower fees, that sounds bad. But translating this from accountant speak into plain English, they implemented a tax planning shift for 2 of their joint ventures, specifically over in Germany. The result? The service fees went down, sure, but equity income from those exact same joint ventures went up. They essentially just rearranged the living room furniture on how they collect their cash from partners, all to optimize their tax bill. It's just a savvy accounting shift, not a fundamental business failure. Section 5. Red flags. And yeah, we are talking about bleeding cash. However, as much as we like a good strategy, not everything can just be hand-waved away as a strategic investment or a clever tax maneuver. We need to zoom in on the real risks right now, which are primarily sitting right there on the cash flow statements. If there is one single rule you take away today, let it be this: cash flow beats accounting profit when they disagree. Every time. Operating cash flow is the ultimate truth teller. It strips away all the accounting fiction and simply asks one question: did the core business actually generate cash, or did it consume it? And man, here is the massive red flag for NTIC. Over the first 9 months of last year, the business generated a very healthy positive $3.8 million in operating cash flow. Over the first 9 months of this year, that swung hard to a negative cash burn of about $758,000. The vending machine is literally eating its own cash right now. This massive negative swing in cash flow is exactly why that dividend had to be cut. It wasn't optional, it was a forced move. They're facing a serious working capital squeeze. Their joint ventures, especially those ones in Germany, just sent less cash distributions back to the mothership this year. At the exact same time, NTIC's debt costs are rising, and raw material inflation is really biting into them. They simply had to stop paying their shareholders so they could afford to pay down their revolving line of credit. Which brings us to Section 6. The bottom line, that profitless prosperity we talked about. So, what's the verdict on this filing? NTIC is a fundamentally durable industrial materials business with a really solid global footprint, but right now they are totally trapped in a cycle of profitless prosperity. So what do we need to watch for in their next 10Q to see if they've actually patched this leaky bucket? Track these 3 things. Number 1, not your tax sales growth. They just signed a preferred supplier agreement with a major packaging distributor. We need to see that actually turn into real hard revenue. Number 2, debt levels. Keep an eye on the balance sheet to confirm that suspending that dividend is actually aggressively paying down their credit line. And number 3, gross margin. We absolutely need to see if their pricing power can eventually catch up to inflation or if those margins are just going to remain permanently squeezed. So the big question, can NTIC turn those record top-line sales into actual, tangible cash? Or will this giant vending machine just keep eating its own profits? That is the ultimate question moving forward. And hey, that's your Edgar brief on NTIC. Remember, this was a translation, not a recommendation. Go read the original on sec.gov if anything here piqued your interest. Thanks so much for being with us for this explainer. Keep learning, stay focused, and I will see you in the next filing.